Hello and welcome to Fundu Money. Here we will discuss a very popular topic, or shall I say, a topic where we get a lot of questions from our followers and viewers and listeners that relates to unit-linked insurance plan surrender. So surrender of unit-linked insurance plans. So we'll try and cover some of the major areas where we get a lot of queries, so that you can have it as a useful reference. And now unit-linked insurance plan are a combination, as we know, of life insurance coverage and investments in market-linked funds, ULIP funds, and depending on your risk appetite, risk profile, and requirements, you can invest in them. They're long-term investments, 15 years, 20 years, 25 years, and so on and so forth. So basically, a lot of people invest in them so that they can invest in equities through ULIPs, and it's actually from that standpoint, it actually gels well in that from that standpoint, because you need to be invested in the long term in equities or equity oriented investments to get the maximum benefit. Now, one of the things that in a discussion on surrender of ULIPs is important is to know that there's a 5-year lock-in for ULIP investments, and you cannot get your money before that. Now, even as we discuss this, we would point out to some of the links we are providing on ULIP cost, ULIP charges, which you can track, follow, and understand, and they go hand in hand with surrender, so that if you understand them well, then some of the decisions, some of the information that we need to use while considering ULIP surrender, you have them in place, right? So 5 years is the lock-in period. So some of the conditions actually apply if you surrender the policy, unit-linked insurance plan, before 5 years, and some will apply after 5 years. Now we are doing a broad coverage in a while it's comprehensive and broad, but there are many twists and turns depending on the policy and some of the interpretations, and they have also some of the tax related regulations have undergone some changes, so we need to keep that in mind. But in terms of information that we want to give you, one is the whole set of things that apply when you are surrendering before 5 years, and then another set which apply if you are surrendering after 5 years. So we'll be coming back to you with the details, but that's coming up in just a little while. Welcome back, welcome to Fundu Money. We are discussing ULIP surrender, unit-linked insurance plan, surrender of unit-linked insurance plan. Now we have done a separate discussion on endowment plan surrender. You can check that out, the links are given, and also do check out about ULIP costs, because all of them are, when you get a sense of these discussions, you'll get a good idea what are the things which are replaced. Now, as we mentioned, 5 years is an important period. Now, till 5 years, you have to wait out 5 years and before you get the money. So, if you are going to be surrendering it before 5 years, certain conditions, certain things you have to keep in mind, and after 5 years, certain things apply. So, let's jump into the pre-5-year period. So if you are surrendering the plan before 5 years and you have availed of the tax deduction, so you pay a premium, right, and you normally till rupees 1.5 lakh of premium, you can claim section 80C deduction up to rupees 1.5 lakh for the premiums you pay. In some of the recent budget announcements and changes that have happened, for 2.5 lakhs, a premium of 2.5 lakhs, you don't get tax-free maturity proceeds. So when you one of the great things about a product like ULIP is the maturity benefits, what the money you get after the plan matures. it is supposed to be tax free, and that's assuming that you pay 1.5 lakh up to 1.5 lakh of premium. But if you've gone up to 2.5 lakhs for single policies or all ULIP policies together, the maturity amount has ceased to be tax free. But let's come back. Let's take a regular sort of a case. The most common cases, we're not talking about higher net worth individuals. Here what happens is till 1.5 lakh you can claim tax benefits. The assumption is that if you hold it for the till the end of the term, the maturity amount is going to be tax free. Now suppose you have availed of tax benefits. Here are some of the things that will happen. First, whichever year you surrender, you have to pay a surrender charge. So remember, we are just talking about ULIP costs and ULIP charges. You can look at that, you can go through that discussion. We have discussed the surrender charge. You have to pay the charge, the money gets into what is called a discontinuance fund, or there could be any other name given to it over a period of time. But let's call it a discontinuance fund. You pay the surrender charge or the discontinuance charge, and that's got deducted from your accumulation. It gets parked there. It only earns about 4% per annum, and fund management charge is likely to get deducted. So that's the second charge that you continue to pay. So when you're buying a ULIP, you can check these things out, as we have mentioned in that discussion. So this is something that has happened. Now what happens is you had availed of tax reductions when you paid the premium, in the year you paid the premium under Section 80C. What will happen is, if you are surrendering it for 5 years, after 5 years when you get the money, whatever were the tax reductions, they get added back. That amount, suppose you had a premium of 10,000, next year you paid a premium of 10,000, 20,000 was the tax reduction. Now 20,000 is going to get added to your income in the year you receive the money. Okay, so that year you receive the money, it gets added to your income and it gets taxed, right? It'll be in the other income segment of your tax return. So that's number one. Number two is, suppose you have made some kind of gain. What would be the tax treatment? Now this is where a common thread will apply. So if your premium, if the premium that you are paying is and the life insurance amount, the relation has to be such that the life insurance amount has to be more than 10 times or more than 10 times of your annual premium. So 10,000 is the premium, 10 times is 1 lakh or more. So that's how the whole thing works out. Now this is a key part for you to have also. This is another important part for you to have tax-free maturity benefits. This is a key condition under all conditions, and now under the new rules, anything below 2.5 lakhs or 2.5 lakhs or less, that kind of premium, single policy or all policies, to have it to have a tax-free benefit. This is the condition. But under Section 80C, which is the tax reduction of premium, the upper limit is 1.5 lakh. So what basically is happening is, if it was 10 times or more, then what happens is it's tax free. But what happens if it is not, it's less than 10 times, then what happens is the gains that you made will become taxable. They have become taxable. But how will the taxability happen? Now our understanding is that depending on the fund that you are invested, it will be taxed accordingly. So if it was an equity oriented fund, 65%, more than 65% in equities, that's the cutoff, then it will be taxed like equities. So if obviously you're getting the money after you would have paid 1 year of premium, and maybe you surrendered it at a certain point, 1 year, 2 year, whatever premium. This is likely to be a long-term capital gain that you made in such circumstances, and therefore it will be taxed at 10% long-term capital gains tax for capital gains made over 1 lakh. So when you get the money, if it's, and the 10 times annual premium condition wasn't met, then what happens is you get taxed for long-term capital gains. If the ULIP fund was an equity-oriented fund, 65% and more of investments in equities. If it is less than that, then it will be taxed like a debt fund, where you get indexation benefits, inflation indexation benefits. So whatever capital gains you made, rather shall we say the cost of acquisition, gets indexed for inflation, movement of inflation during that period, and therefore the capital gains becomes lesser, and on that 20% long-term capital gains tax. So this is our understanding of how the taxation will happen if you had claimed tax benefits, and so that part, the tax benefit part is getting added, but the capital gain part will depend on the 10 times annual premium to life insurance amount relationship that has been stipulated. Remember, that is a key part for your maturity proceeds to be tax-free under section 1010D, right? So this is part 1, right, where we are talking about before 5 years, and you had taken taken tax deduction. Now, what if you hadn't taken tax deduction? So it's exactly this is only a minor change from the first case. What happens again? You surrendered it before 5 years, so the money you pay surrender charge, and the money moves on to your discontinuance fund. It earns some basic interest of 4%, and when you get the money, what happens then is when you get the money, now because you hadn't claimed any tax benefits, so that those benefits are obviously, the question doesn't arise of those benefits getting added to your income. But depending on whether the 10 times annual premium condition, life insurance amounting 10 times annual premium or more, then that will determine whether the money, the capital gain part, will get taxed. So if it's getting met, the life insurance amount was 10 times annual premium or more, it's tax free. But if it wasn't, again, whatever we discussed, so depending on the fund that you invested, so if the ULIP fund was equity, then it will be taxed like equity fund, right? And typically it's most likely to be a long-term capital gain, and it will be taxed like a capital gain. But depending on the case, the interpretation, etc., and how things evolve in terms of the tax laws, etc., you can check with a tax expert. This is what we understand. So equity, it will be taxed like an equity investment if that 10 times annual premium condition hasn't been met, and you invested in an equity oriented fund. Otherwise, if you're invested in a sort of a non-equity kind of a fund, it will not be called a debt oriented fund in that sense, but yes, it's 65, less than 65%, therefore it will be taxed like a debt fund or a debt investment, and again inflation indexation and 20% long-term capital gains tax. So this is the part which is before 5 years. What happens if you do it after 5 years? If again the 10 times annual premium condition is met, then what happens is whatever money you're getting is tax-free, and there's no lock-in. Now the lock-in is gone. Whatever money you're getting is tax-free. So no add back of tax benefit claimed, etc. They become irrelevant, right? Now what happens is, if the condition of 10 times annual premium, life insurance amount and 10 times annual premium have not got met, it was the life insurance coverage was lesser, again the same treatment will happen. depending on whether the ULIP fund was equity oriented, 65% or more invested in equities, then tax like equities. If it is less than 65%, will tax like debt, inflation indexation at 20%, long-term capital gains tax on the inflation index units, and of course for equity oriented investment it would be 10% of capital gains, annual capital gains for that year above 1 lakh, right? Above 1 lakh you will pay that. So this is how the ULIP surrender dynamic will work, right? So we're not talking about how to apply for a surrender, etc. Those are not the complexities people seem to be bothered about, at least our subscribers and followers of our channel. They seem to be wanting to understand these things, the things that we just discussed, a little more than some of the more basic things that are available on various websites and other places. So we hope you found this useful. If you've liked it, hit the like button, share it with others. Till the next time, take very good care of yourself and goodbye.